Welcome to Intelligent Investor Insights with Joshua Barone and Robert Barone, your co-hosts and guides through the noise of today's markets. Here, we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
So let's rip the Band-Aid off right from the start. Washington isn't quietly tinkering at the margins of global trade anymore. We're deep into what I'd call aggressive, if not outright belligerent, commodity and supply chain statecraft. It's not business as usual post-Cold War stuff. Josh, you've written about this, and I keep coming back to the question, is this just some Monroe Doctrine cosplay, or is it fundamentally new?
Yeah, Dad, it's tempting to see echoes of the Monroe Doctrine, but honestly, this isn't just elbowing rivals out of the backyard. This is way bigger. And I mean, what we're seeing is the US pulling basically every lever, military, financial, whatever, to secure everything from lithium to oil. And not just to keep China honest, they're collapsing decades of capital efficiency to get there. Trade liberalization is over. Now it's about physically owning the supply chain end to end, even if it costs a fortune or two in efficiency.
Right. This isn't theory either. There's a quantifiable cost. Companies and even sovereigns don't have the luxury of efficiency anymore. The investment dilemma. Do you want paper assets backed by policy promises, or do you want to own something tangible when the rules are changing mid-game? That's the tension investors are living with right now. The death of trust in fiat, the bet on possession, all of it. And let's talk about the moat, the U.S. military buildup in the Caribbean. Not a term you hear in polite bond market circles, but the Pentagon's dead serious. It's a kinetic response to China's dual-use infrastructure playbook. General Laura Richardson pretty much flat out said, those ports aren't just for shipping bananas. They're slow-cooked forward operating bases in disguise.
Yeah, it's wild. I remember the first time I really saw that strategic shift was after Hurricane Maria visiting Puerto Rico for what was supposed to be like boring due diligence. And suddenly the port was crawling with logistics units, not just aid, but the kind of stuff that screams, we're thinking about perimeters now. U.S. planners see the Caribbean as their front yard, and any Chinese-built infrastructure sends off DEFCON-level alarms about supply chain security.
Exactly. It's not incremental tinkering. It's a defensive wall. The risk for investors, you get supply interruptions, you get escalation, you get CapEx spent on security instead of innovation. Not trivial spillover, especially if you've got capital allocated to anything dependent on these physical perimeters holding firm.
Then it gets even messier when you layer in oil politics. The confrontation in the Guyana-Suriname basin, totally about cutting Venezuela out of China's oil loop. Stabroek Block is the new fulcrum. Washington's using every tool, not just military, to set up a fortified energy corridor aligned with U.S. interests. It's the opposite of subtle.
I mean, Petrocaribe lost out almost entirely, not because of market forces, but because Washington wanted to bottle up Venezuela's crude flows. It's short-term thinking masquerading as strategy sometimes. You choke off Venezuelan oil to China, but you're also making the system brittle. Risk gets pushed somewhere else. It doesn't disappear.
Exactly. The breach, as the Pentagon likes to call it, isn't about political ideology anymore. It's about raw resource control. If you're betting your portfolio on stable oil flows in the hemisphere, better reread those energy supply chain maps. You can't trust headlines. You have to follow which ports and which companies are under whose thumb this week.
There's another layer to this, financial statecraft. The U.S. Development Finance Corporation is straight up de-risking private capital, so American firms can dig up lithium and copper in South America without worrying about regime change every election cycle. Argentina is getting special status, politically becented, if you will, thanks to ESF backstops. It's government underwriting for critical minerals, all to counter China's direct investments.
But China's got their own move, the Chancay megaport in Peru. Port's enormous, and it lets them bypass every US-controlled route. It's like they saw DFC coming, shrugged, and just built their own off-ramp to China. This is the literal physical splitting of supply chains. You want to talk about a tug of war? Both sides are pouring capital and political risk insurance into the same pile of rock sediment.
State-sponsored insurance for investment risk used to be rare. Now it's how the critical mineral game is played. Investors need to recognize that the rules of sovereign risk are changing fast. You can't just run a DCF and call it a day anymore. You have to account for whose flag is flying at the port when the shipment leaves.
Now, here's what keeps me up at night: the cost. Just in time is toast. Everyone's hoarding, no one's optimizing. It's now just in case, which is code for inventory bloat. 20 to 30% a year eaten out of every dollar of inventory sitting around. Free cash flow takes a beating. When I'm going over cash flows with clients every quarter, swear the warehouse ghosts start haunting me. Every box that doesn't move is a chunk out of their future dividends.
And all those shiny earnings you see on TV, a lot of that is inventory-fueled GDP growth. That's not real. It's a patch, not a cure. If Wall Street gets excited about resilient companies piling on inventory, they're ignoring that every extra dollar in stock is dead capital dragging on returns. It's a structural tax on margins, and it isn't going away.
Yep, the cost of capital shock is real. Working capital needs up 22%, and CapEx is what gets cannibalized. R&D budgets get cut because, well, someone's got to pay for all those warehouse security systems, right?
But the US isn't fighting a mirror image. China's got a built-in advantage, a full-blown command economy for commodities. State-owned firms stockpile everything. No one outside the Politburo gets the real numbers, but just look at copper or rare earths. They buy when it's cheap, store it, then dole it out to manufacturers. Western firms simply can't compete. Supply chain volatility? Not if you have a command economy smoothing the rough edges.
Yeah, it's like watching two teams play a different sport. Market logic can't beat state-mandated stockpiling. That's price stability for Chinese factories, full stop. But here's my question. Bob, does that mean China's genuinely more resilient, or just hiding systemic risk under an even bigger pile of copper and IOUs?
Good question. I'd say it's a little of both. Government masking risk buys time, not invincibility. At some point, if your stockpiles backfire, if prices crash or you miss a technology inflection, you're suddenly holding a warehouse of obsolescence. But in the short run, their system wins on stability, period.
It's not just about stockpiles either. The Eurasian bloc is building routes overland, not through U.S. policed waters. Power of Siberia 2 pipeline's a prime example. Russia lost Europe, so now direct line to China instead. And get this, payments in rubles and renminbi, not dollars. That chips at the heart of U.S. monetary dominance.
Absolutely. That's how you make sanctions weaker. Bypass the dollar. If U.S. sanctioned oil just goes overland and U.S. Navy can't touch it, what does the West do next? The more pipelines, the less persuasive the global reserve currency argument looks. If this scenario keeps growing, U.S. fiscal policy will feel the pressure first and fast.
Yeah, anybody who thinks the dollar's position is unshakable hasn't looked at these energy deals. All it takes is for a few energy exporters to make trading in local currency sticky. And suddenly, the U.S.'s biggest weapon, finance, isn't so scary.
All right, let's zoom back into the company level. This just-in-case world is squeezing every corporate balance sheet that's not a monopoly. Working capital requirements up 22% overwrites CapEx, as you said. Margins get crunched. I don't think analysts on Wall Street are pricing that in at all. They're reluctant to admit it because it makes the sell-side research less sexy.
Exactly. I've got a real client story. Can't use the name, obviously, but manufacturer out west had to cut back new product development just to cover rising warehouse and insurance bills. It's not that they don't want to innovate, they just literally can't, not if they want to keep their creditors happy. So the cycle feeds on itself. Less innovation, fatter inventories, and the so-called resilience is just a slowly tightening vice on future growth.
That's the unvarnished reality behind the headlines. Inventory management becomes survival strategy. Everything else, growth, CapEx, even dividends, has to play second fiddle to the new gods of warehousing and resilience. Investors who miss that are flying blind.
Which brings us to the ultimate hedge, gold. For the first time ever, let me check my notes. Yeah, it's true. Central banks are holding more gold than U.S. treasuries. You've got this doom loop thesis from the World Gold Council and folks like Tavi Costa. With every uptick in central bank buying, you get reinforcing momentum. Everyone's front-running everyone else, almost like a virtuous cycle, if you believe in gold as insurance.
That's the big signal. When reserve managers in emerging markets start piling into gold, they're telegraphing something investors need to catch. There's a flight from yield to possession. Gold's got no counterparty risk. In a world increasingly defined by state aggression and financial uncertainty, that's not just a hedge, it's a statement about the failure of the dollar-based order.
Exactly. The smart capital isn't rushing into risk-free paper, it's rushing into what it can touch, weigh, and move if it needs to. We're watching trust get repriced in real time, one central bank vault at a time.
But ultimately, all of this, the new commodity statecraft, the hardening of hemispheric lines, the scramble for possession, it's brought to ground by one uncomfortable fact. America's fiscal base is fragile. The U.S. is now spending more on interest than on defense. Ferguson's law in action. Governments hit a wall where even military muscle can't patch over balance sheet rot. This is fiscal dominance in real time.
Yeah, it's not a hypothetical anymore. When investors see that the Fed's handcuffed by the Treasury's borrowing needs, confidence unravels fast. The so-called bond market veto hangs over the whole structure. It's the ultimate vulnerability. You don't need a tank battalion to force America's hand, just a well-timed bond sell-off.
Exactly right. Real strength isn't in GDP headlines or government-engineered resilience. It's in what you own. When trust in fiat is wavering, investors need to focus on tangible assets. I'll say it one last time. Possession beats promises, especially when the rules are being rewritten.
That's a wrap for today, folks. If you're feeling a little less upbeat about efficiency and a little more interested in hard assets, well, mission accomplished, I guess. Bob, thanks for keeping me honest as always, even if you're a bit too good at it sometimes.
That's my job, Josh. And to everyone listening, stay skeptical, do your own homework, and remember that the smartest money in the room isn't chasing trends, it's protecting what it can actually hold.
We'll dig even deeper in our next episode. Josh, see you then.
See you next time, Dad. Thanks everyone for tuning in. Take care.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late-cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional-level analysis, and a partner in building durable wealth. Reach out to start the conversation and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational. stay disciplined, and invest with intelligence.